Welcome to the deep dive. We're here to bring you the signal from the noise, and today we're doing a surgical strike on a sector that a lot of investors tend to ignore, or maybe even dismiss as, too dull. Self-storage.
Exactly.
We're putting Public Storage, that's PSA, the largest owner and operator in the space, under the most rigorous microscope we can.
And that skepticism you mentioned is exactly what we're here to address. This isn't a deep dive for someone just, learning the acronyms. Our mission today is really tailored for the experienced critical investor.
Right.
The one who understands that genuine alpha isn't found chasing fleeting trends, but in identifying these structural advantages that deliver resilience across cycles. We really need to determine if PSA truly holds that title of a blue-chip safe haven, a quality compounder, or if, the current valuation is just a low-growth income proxy.
That's the tension, isn't it? That's what we're tackling. Because when you pull up the basic numbers, you see PSA trading around, 16.7 times 2025 estimated FFO.
That's the number.
It's got a very respectable dividend yield. It's hovering near 4.4%. So the question for serious capital is whether this pricing is adequately discounting the significant latent growth levers that management has been building inside the operational machine, especially over the last 3 very challenging years.
And as we frame this analysis, the starting point, it has to be the balance sheet.
Mm.
In a world where the prevailing mantra is higher for longer interest rates, which have, violently rewritten the cost of capital across the entire real estate sector.
Everyone.
For everyone. An A2A credit rating isn't just a sign of financial health. It's a competitive moat of the highest order.
That A-rated balance sheet is essentially a weapon, right?
It is.
Oh.
It's absolutely a weapon.
Yeah.
This fortress of financial strength lets PSA stay active. They can build, they can acquire, they can refinance debt cheaply, and they can do it at a time when so many of their highly leveraged peers are just sidelined.
They're stuck.
Completely stuck. They're facing prohibitive debt costs.
Right.
They often find it impossible to execute new developments or fund large acquisitions in a way that's accretive. So this is a structural advantage that drives value, even when organic growth is tough to find.
Okay, so let's unpack this entire structure. We're going to deconstruct the analysis into, let's say, 3 high-level buckets. First, we'll tackle the current macro paradox, this bizarre environment where you have frozen demand colliding with a looming supply cliff.
Yeah.
Second, we'll dissect the operational alpha, how PSA is using digital transformation to create what looks like permanent margin expansion. And then finally, we'll do a critical assessment of management's capital allocation, specifically scrutinizing their choice to prioritize high-yield development over, say, aggressive share buybacks.
And it's really about understanding that in a mature REIT sector like self-storage, outperformance isn't achieved anymore by just owning great real estate.
Right.
It's achieved through sophisticated operational execution and disciplined capital deployment that manufactures a quantifiable value spread.
So let's set the scene with that macro picture, because this is really where the market's anxiety is right now. Self-storage has long been heralded as recession-resistant, driven by the famous sort of morbid 4Ds.
The 4Ds, yes. Death, divorce, dislocation, and downsizing.
Exactly. And the critical variable, the one that really pumps massive new customer volume into the system, is dislocation. Residential mobility or simply people moving home.
And that variable, as we've seen over the last, 18 to 24 months, is just running on fumes. The central headwind, the dominant story of 2023 and 2024 is the frozen housing market. Mortgage rates moved from historic lows into the 6.5% to 8% range with, brutal speed.
Creating that now infamous mortgage lock-in effect.
Precisely. If you're a homeowner in the U.S., lucky enough to have refinanced or bought a home with a sub 3% mortgage rate, and there are tens of millions of them.
A huge portion of the market.
Huge. You are fundamentally trapped. Why would you sell your existing home, trigger a massive capital gains event, and then go buy a new, more expensive home with a mortgage that's 2 to 3 times the cost of your current debt service?
You wouldn't. The math doesn't work.
The financial incentive to move is it's annihilated.
And that inertia in the housing market, that translates directly into pressure on the storage industry's top line. We saw existing home sales just plummet to multi-decade lows. Activity levels not seen since the 1990s in some metrics. So what was the quantifiable impact on PSA?
The pressure is quantifiable, and it's stark. PSA reported that new customer move-in volume, which is the lifeblood of revenue growth, it declined by approximately 9% year over year in the third quarter of 2025.
Wow.
That is a significant hit to the top of the funnel.
9% fewer people walking through the door or clicking rent now. That forces an immediate pivot in management philosophy, doesn't it?
It does. It forces a fundamental strategic shift. When your primary volume engine stalls, when you can't rely on just filling more units, the operators have to pivot instantly to this highly sophisticated, yield-based management.
Maximizing what you have.
Exactly. This means maximizing the revenue you can capture from your existing stable customer base,
Yeah.
because new customer acquisition is suddenly very expensive and very difficult.
Okay, so here is where the story gets really complex and why we're focusing on the structural advantages of PSA. You've got this massive demand-side headwind, the housing freeze, but there's an equally powerful structural tailwind developing on the supply side, the supply air pocket.
This illustrates capital cycle theory in action, but with a critical twist. Historically, self-storage has been, prone to oversupply.
Right. It was easy to build.
Very easy. High returns attracted merchant builders, they'd flood submarkets with new projects, and that would suppress pricing power for years. But the current rate cycle just breaks that pattern entirely.
Because the high interest rates and the simultaneous tightening of bank lending standards have just dried up all the construction financing.
Exactly. Merchant builders, who typically operate on these razor-thin margins and short debt windows, they can't afford money at 8% or 9%. That financing landscape has effectively decimated the new construction pipeline. Construction starts have just contracted sharply all through 2024.
And the pipeline data confirms this, right? It's projecting a genuine supply cliff. New deliveries are forecast to drop dramatically, something like 15% in 2025, and an even steeper 18% in 2026. This isn't just a slowdown, this is a looming vacuum of new competitive supply.
And this is where PSA's incumbent advantage just shines, and it stems purely from their geographic portfolio. PSA is heavily concentrated in those high barrier-to-entry coastal markets. Think the highly dense corridors of Los Angeles, San Francisco, the New York metro area.
Right, markets where it was already almost impossible to build because of hyper-restrictive zoning, environmental regulations, land costs that make any development infeasible unless you're someone like PSA who can self-fund.
Precisely. In these markets, new supply is virtually non-existent, which just intensifies that supply cliff effect. As an investor, the critical insight here is this. PSA's existing portfolio is insulated from competitive dilution today.
Okay.
But more importantly, once residential mobility finally normalizes, which all cycles eventually do, that lack of supply in their key markets sets the stage for exponential future pricing power. They could potentially command peak rents in 2027 and beyond. They are weathering the demand storm, knowing their fortress won't be breached by new competitors.
So we've got a clear temporary demand suppression, but it's counterbalanced by a structural, multi-year supply-side advantage. That sets the foundation perfectly for our next point. How do they bridge the gap until, say, 2026 or 2027?
That gap is bridged through operational alpha, which is really the true differentiator here. When the macro environment turns against volume growth, management has to show tactical brilliance in pricing and execution.
And that brilliance is crystallized in the defining characteristic of the 2025 storage market, this pricing bifurcation. The divergence between the rates offered to new customers, the street rates, and the rates paid by existing tenants, the contract rates.
Let's start with the deflationary reality. To capture that shrunken pool of new movers, that 9% smaller volume we just talked about, operators were forced into these fierce, short-term price wars.
A race to the bottom.
For new customers, yes. PSA acknowledged that move-in rates in early 2025 fell by about 5% to 8% year over year. Management even noted these rate levels had not been seen since 2013. That is profound short-term pressure on the top line.
It sounds like a terrible sign in any competitive market.
It would be if they didn't have the structural counterlever. And that counterlever is the existing customer base, which is incredibly sticky. You, the customer, are sitting there with a storage unit full of your possessions.
Yeah.
Despite the lower street rates being offered just down the road, the physical hassle cost, the time, the truck rental, the labor, the risk of damage.
It's just immense. It's the ultimate switching cost.
Exactly. And PSA demonstrated they are masters of capitalizing on this inelasticity. Despite those falling street rates, they maintained the ability to increase realized in-place rents, the contract rates, by a surprising 0.6% in the third quarter of 2025.
So they're successfully extracting more revenue from their existing stable base, even while the environment is pressuring new volume.
They are.
This brings us to the famous self-storage J-curve model, which we should probably slow down and explain for listeners who might not track the sector-specific jargon.
Okay, so the J-curve is PSA's sophisticated revenue management strategy visualized. New tenants, the ones from that 9% lower volume pool, they enter at a negotiated discount. This intentionally drags down the short-term revenue per available square foot, or REV-PAF.
That's the initial dip of the J.
That's the dip. It's a calculated discount, a loss leader. But once that customers lock in, the proprietary revenue management algorithms aggressively apply occupies, existing customer rate increases, typically within 6 to 9 months, sometimes even sooner.
So they absorb the hassle cost, they sign the lease, and then the algorithm just starts raising the rent, counting on the fact that the customer will accept the increase rather than go through the pain of moving again.
That's the core mechanism. They capitalize entirely on the inelasticity created by that hassle factor. PSA isn't just accepting lower rates. They are strategically using discounts to fill units today, basically purchasing future revenue stability at a slight discount, knowing the ECRIs will quickly drive those contract rates back above the initial street rate, and that completes the vertical rise of the J.
That structural ability to execute those ECRIs without causing a massive wave of churn is really the ultimate validation of their market position and customer stickiness. But even that aggressive pricing strategy only goes so far if your costs are running rampant with inflation.
Which leads us to the other half of the margin equation, expense defense. And this is the biggest structural story of all. It's the digital transformation, which accelerated during the pandemic and has fundamentally altered PSA's entire operating expense profile. This was a pivot from a labor-intensive retail model to an automated logistics model, all through their rental platform.
Tell us about the adoption figures, because the source material suggests PSA is running miles ahead of the pack here.
The gap is enormous. Nearly 75% of PSA's new customer rentals are now completed digitally, end-to-end, often with zero human intervention.
75%.
75. Now, for context, their public peers are hovering around the 30% adoption mark. This disparity is critical because it drives two things: lower effective customer acquisition costs, because the digital funnel converts so efficiently, and, more importantly, structural cost reduction.
Which enables the unmanned model, moving away from the high cost of a resident manager living on-site, which was, the legacy structure for the entire industry.
The unmanned model uses either a centralized hub-and-spoke system, where one manager oversees multiple properties remotely, or fully remote agents handling all customer interactions from centralized call centers. Management confirmed these initiatives have resulted in a total labor hour reduction across the portfolio of more than 30%.
A 30% reduction in the largest controllable expense line item, labor. That's just staggering. And we can see the immediate financial result of this operational change in the most recent quarter.
We do. And this is the key stat that defines their competitive position. In Q3 2025, PSA reported a 0.6% decrease in same-store operating expenses.
A decrease.
You heard that right, a decrease. They were deflationary on their cost structure during a period when wage and insurance inflation were raging across the U.S.
Well, inflation was hitting every other business model out there.
Absolutely. Now let's bring in the comparison to their largest peer, Extra Space Storage, EXR. In that same Q3 2025 period, EXR reported expense growth of 8.6%. That enormous chasm PSA at negative 0.6% versus EXR at plus 8.6% demonstrates that PSA has engineered a profound structural separation from inflationary pressures. This structurally lowers PSA's break-in occupancy point permanently. It ensures that when that 9% move-in decline finally reverses, an outsized portion of that new revenue will drop directly to the FFO line.
That structural cost advantage changes the math on the entire enterprise. It means that even if revenue growth is flat, FFO can still increase simply due to operating leverage. Hashtag tag 3, the asset base and geographic moats.
And if the digital transformation is the efficiency engine, then the asset base is the high-performance chassis that provides the stability and the regulatory protection.
Scale is often just a vanity metric, but in this case, PSA's sheer size, 3,491 facilities, 254 million net rentable square feet, that functions as a genuine competitive weapon.
It creates massive operational leverage. That expensive, sophisticated rental platform, the proprietary revenue management algorithms, the call centers, the national ad campaigns.
All those fixed costs.
All of them get amortized over a revenue base that's nearly double their next closest competitor. It makes that huge upfront investment in technology, the investment that enabled that negative 0.6% expense cut economically viable.
And the portfolio quality itself is key. We're talking about highly selective positioning in urban infill, high-density coastal markets, locations where replacement costs are astronomical and land is just scarce.
Precisely. They have assets where the competitive threat of a new development popping up across the street is incredibly low, if not zero. And critically, we have to focus on their California concentration. Los Angeles and San Francisco metros account for a disproportionate share of their net operating income, or NOI.
And why is California such a double-edged sword? I mean, it's high density, high demand, high income, but it's also highly regulated.
That's the tension. However, their legacy portfolio enjoys a unique, highly valuable protection that is often overlooked by national investors. Proposition 13.
Okay, so explain how Prop 13 works for a REIT that's owned property for decades.
Prop 13, which was enacted in 1978, caps the assessed valuation increase for property taxes at a maximum of 2% annually, unless there's a change in ownership.
Okay.
Because PSA has owned many of its most valuable properties for 20, 30, and 40 years, the tax basis on those legacy assets is shielded. If a competitor bought an equivalent piece of land today, they would pay property tax on the current market value. PSA pays tax on an assessment that might be a fraction of that, adjusted only by that tiny 2% annual cap.
That is a...
Oh, it was absolutely strategic. The program was designed to align the physical assets with a new digital operational model. They introduced Generation 5 architectural standards, modern aesthetics, LED lighting, digital signage. It's all about making the properties appealing to that high-converting digital renter. But the real ROI is in the sustainability investments.
That's just the solar power installations.
Yes. They are targeting solar power installation on 1,300 properties by 2026. Utility expenses, electricity, water, and so on, they represent one of the largest controllable operating costs after labor and property taxes.
Sure.
So by generating their own power, they are directly and permanently reducing utility expenses, further improving NOI margins, and locking in that superior expense structure we saw in Q3.
Yeah.
This CapEx is self-funding over time through reduced OpEx.
Now, let's shift to their exposure beyond the U.S. What is the role of that 35% equity stake they hold in Shurgard Self-Storage?
That stake in Shurgard, the dominant Western European operator listed on Euronext, is a strategic masterstroke. It acts as a valuable European call option. The value currently sits at over €1 billion.
So what's the investment thesis for holding a massive minority stake in a foreign operator?
It's all about market maturity arbitrage. The European self-storage market, in terms of facility penetration per capita and just general consumer awareness, is estimated to be 15 to 20 years behind the highly saturated U.S. market.
So a much longer, less competitive runway for organic growth and greenfield development across key cities like London, Paris, Amsterdam.
Precisely. And for the critical investor looking at portfolio construction, that stake provides a diversified high-growth revenue stream that is largely uncorrelated with U.S. housing market dynamics. If the U.S. housing freeze drags on longer than expected, the growth engine in Europe just keeps running, providing a stable, geographically hedged source of FFO growth through equity and affiliate earnings.
Okay, let's pivot now to the financial architecture. When organic same-store NOI growth is flat, and it was, remarkably, at 0.0% in Q3 2025, management can't just rely on operations. They have to manufacture value.
That's right.
Core FFO was $4.31 per share in Q3 25, which, grew 2.6% year over year. That growth is coming from manufactured value, which means smart capital deployment.
And the primary engine of this manufactured value is what we'd call the crown jewel, their high-yield development pipeline. While the cost of capital forced most peers to completely shut down their development programs in 2023 and 2024, PSA maintained its pipeline. It stands about $650 million, set to add 3.9 million square feet of rentable space.
So they're using that low-cost, A-rated balance sheet to build at a time when literally nobody else can afford to.
And the genius of this is in the yield spread. PSA targets stabilized net operating income yields of approximately 8.0% on these ground-up developments. This means for every dollar they spend building, they expect to generate 8 cents of annual NOI. Now, you contrast that with what fully stabilized, Class A existing storage facilities are trading for in the acquisition market.
Which is defined by the market cap rate, and that's typically in the 6.0% to 6.5% range for premium assets.
Correct. That 150 to 200 basis point spread between their cost of manufacturing an asset, the 8.0% yield, and the market price of an equivalent asset, the 6.0% cap rate, that represents immediate quantifiable shareholder alpha.
Let's quantify that for the listener. Can you walk us through the math on that?
Sir, take a simplified example.
Yeah.
For every $100 million PSA invest in development, it generates $8 million in stable NOI. If the market then prices that $8 million of NOI at a 6.0% cap rate, the implied market value of that newly created asset is $133.3 million. The difference between the $100 million cost and the $133.3 million market value is roughly $33 million in instant manufactured shareholder value. This is a perpetual source of accretion that, financial buyers who lack PSA's balance sheet and development expertise simply cannot replicate.
This disciplined approach brings us to a frequent critique, though, that you hear from activists and some shareholders. Why don't they execute more aggressive share buybacks, especially when the stock looks cheap? They only repurchased $200 million in Q2 2024.
And that's a valid, high-level question. But management's defense is purely mathematical, and it demonstrates a long-term rational value creation mindset that prioritizes NAV growth over anything else. Repurchasing stock at the current 16.7 times FFO implies an earnings yield of roughly 6.0%.
So they're buying back an income stream that yields 6.0%.
Exactly. So why would you deploy hundreds of millions of dollars to buy back stock yielding 6.0% when you can invest that exact same capital into development projects that yield 8.0%?
It's a 200 basis point difference.
A 200 basis point greater return on capital. While buybacks can sometimes provide a short-term psychological boost or, a signaling mechanism, investing in that 8.0% yield is just mathematically superior. It provides tangible, permanent accretion to net asset value over the long term. This is capital allocation driven by discipline, not by market fashion or activist pressure.
We also saw disciplined M&A, most notably the $2.2 billion Simply Self-Storage acquisition finalized in late 2023. What made that so strategic and accretive?
The context is everything there. That transaction utilized PSA's immense liquidity at a time of severe market stress, and they were targeting a motivated seller. The seller, which was Blackstone's Bright, was facing intense redemption pressure at the time.
So PSA was able to deploy capital countercyclically when assets were basically distressed.
Absolutely. They secured a high-quality portfolio at a compelling valuation, underwriting a year-3 yield of 6.25% to 6.75%. This acquisition was the blueprint. Use your low cost of capital and liquidity during distress, secure assets at an attractive entry cap rate, and then immediately integrate them into your superior operating platform.
Stripping out costs.
Right, stripping out redundant G&A and applying that highly efficient 75% digital leasing technology to unlock immediate margin expansion.
And we saw that accelerated activity continue in Q3 2025 with another, $511.4 million deployed.
And that signals that the bid-ask spread in the private market, the gap between what sellers want and buyers are willing to pay, has finally narrowed. PSA is consolidating assets while many leveraged competitors are paralyzed or just focused solely on debt management.
Finally, we need to touch on the strategic value of the PS Advantage third-party management platform. It's grown to 863 managed stores.
Its value is subtle, and I think it's often misread. The fee income is accretive, sure, but it's marginal in the context of PSA's massive earnings base. The true strategic value is data. Creates a data moat. By managing over 800 stores they don't own, PSA gains granular, real-time pricing, demand, and occupancy data in submarkets where they may not have physical ownership.
Which feeds right back into their underwriting.
Precisely. This vast data set allows them to de-risk future capital deployment. It informs their underwriting for new acquisitions and development far more precisely than smaller peers can manage. It makes their 8.0% development yield target highly achievable because they know exactly where and what to build. It's a data ecosystem that continuously strengthens the core growth engine. #CAR5. Competitive landscape and valuation disconnect.
Let's move to a direct benchmark comparison because you really can't assess TSA in a vacuum. The natural comparison is Extra Space Storage, EXR, which briefly surpassed PSA in total store count after acquiring Life Storage.
And the comparison is essential because it highlights this fundamental divergence in corporate strategy. PSA operates primarily under a direct ownership model focused on the unmanned, highly efficient structure we discussed. EXR, while a quality company, relies heavily on an asset-light, third-party management plus strategy.
And the Q3 2025 metrics really illustrate the immediate operational friction that the EXR strategy, particularly after a huge integration like Life Storage, is now managing.
Just look at the core operating expense line. PSA's same-store expense growth was negative 0.6%. That is the structural efficiency we just elaborated on. EXR's same-store expense growth was positive 8.6%.
8.6.
That differential is explosive. It reveals the impact of wage inflation, insurance cost pressure, and likely significant integration bloat from swallowing Life Storage.
That 8-point difference in expense growth is the difference between operational excellence and operational friction.
And it translates directly into NOI performance. PSA reported flat, same-store NOI growth at 0.0% for Q3, which, given the demand environment, is an incredible display of stability and margin defense. EXR, conversely, reported a same-store NOI decline of negative 2.5%. PSA is winning the efficiency and margin defense battle. They also sport much lower leverage, 4.1 times net debt to EBITDA, making their balance sheet objectively safer for a critical investor focused on stability in a turbulent rate environment.
What about the smaller players, CubeSmart, CUBE, and National Storage Affiliates, NSA? How does PSA's scale dominate them?
CubeSmart is often viewed as a quality operator. They focus on urban density markets, and it generally trades at a slightly lower multiple, around 15 times FFO versus PSA at 16.7.
Right.
Now, while CEB showed better expense control than EXR, their Q3 expense growth was a modest plus 0.3%. They still lack PSA's massive scale.
Right.
PSA's ability to amortize its immense centralized technology investments across 254 million square feet gives it the ultimate efficiency lead, which results in that unique negative 0.6% cost reduction.
And NSA, which uses that participating regional operator, the PRO structure.
NSA's structure, which relies on acquiring regional portfolios and keeping the operators in place, targets secondary and tertiary markets. And while it offers a path to growth, its business model fundamentally relies on constant acquisition and a cost of capital that is significantly higher than PSA's.
So in this environment.
In this high-rate environment where acquisition cap rates are depressed and data is expensive, NSA's acquisition-driven growth engine is just far harder to execute. PSA's ability to self-fund development and acquisitions with its retained cash flow and low-cost debt gives it structural advantage NSA simply cannot access.
So synthesizing PSA's overall financial profile, it is really defined by conservatism and unique structural engineering.
Absolutely. The leverage is remarkably low at 4.1 times net debt plus preferred equity to EBITDA. And that reliance on $4.35 billion in perpetual preferred equity is unique. This preferred stock functions as ultra-long-term, essentially permanent, non-dilutive financing. It insulates common shareholders from the short-term refinancing risks that are currently plaguing so many highly leveraged peers.
It just pushes the maturity wall way out into the future.
Precisely. Furthermore, the company's high free cash flow conversion means the dividend payout ratio is safe and sustainable, sitting around 71% of FFO. And crucially, this leaves roughly $800 million in annual retained cash flow. This enormous retained cash flow is the engine that funds that high-yield development pipeline, allowing them to continually manufacture value without needing to tap volatile equity markets.
Which brings us back to the core question here, the valuation disconnect. Why is a company with this level of operational discipline and balance sheet strength trading at only 16.7 times PFFO?
Because the market is pricing in anxiety. That 16.7 times multiple reflects the market's deep-seated worry about the housing freeze and high rates persisting indefinitely. If you run a discounted cash flow, a DCF analysis, on that price, it mathematically implies that the market is expecting PSA's terminal FFO growth rate to be only 2% to 3%.
Which is essentially pricing in perpetual stagnation.
Exactly. But if we adjust that assumption just slightly, if PSA can manage to return to its historical normalized 4% to 5% growth rate once the housing market finally thaws, the analysis suggests the stock is currently undervalued by 15% to 20%. The market is focused entirely on a temporary cyclical demand headwind, while entirely overlooking the permanent structural margin expansion management has successfully engineered. That gap represents the opportunity. #tag 6, critical risk assessment.
An investment thesis, particularly for a highly sophisticated investor, is incomplete without a rigorous assessment of the downside risks. So let's make sure we're not missing the potential pitfalls here.
The primary external risk, as with every REIT, remains interest rates. The higher-for-longer narrative continues to be the chief threat to the valuation multiple.
So if the 10-year Treasury yield surged back above 5%, say due to persistent, unmanageable inflation, the risk-free rate of return becomes highly competitive with PSA's 4.4% dividend yield.
And that would almost certainly trigger multiple compression. Regardless of the company's internal operational excellence, money would just flow out of equity instruments and back into fixed income. That's an immutable law of REIT valuation.
Secondly, let's address the inflation that PSA can't control, specifically property taxes. We lauded their control over labor and utilities, but property taxes are dictated by local governments who are facing their own fiscal pressures.
Correct. In unprotected markets, those without Prop 13 property taxes are a major threat, consistently rising faster than rent growth, eroding those hard-won margins. Management has to be highly agile in their pricing to offset this, which is why that operational efficiency is so vital.
And this brings us back to the California elephant in the room, regulatory risk. PSA's geographic strength is also its greatest regulatory vulnerability.
And the company has already quantified the immediate impact of local interference.
Yeah.
PSA explicitly noted a negative impact of $0.23 per share on 2025 FFO guidance.
23 cents.
All due to rent restrictions imposed by the city of Los Angeles during its declared states of emergency things related to homelessness or wildfires. This is a direct, measurable consequence of governments using emergency powers to introduce rent control, even on commercial assets like self-storage.
And the existential risk remains the legislative attempt to repeal Prop 13 for commercial properties, the split roll tax.
This is the ultimate persistent threat. If California were to pass a split roll measure, it would immediately decimate PSA's legacy earnings power on its oldest, most valuable assets. Their tax basis, which has been protected for decades, would reset to current market value, leading to a catastrophic increase in property tax expense. Now, while previous attempts have been defeated, the political motivation to unlock that commercial tax revenue remains high. Investors have to be keenly aware that this specific regulatory risk is disproportionately attached to PSA due to its California concentration.
And finally, we have to mention market saturation. While the national supply picture is favorable because of the supply cliff, not all markets are created equal.
No, we're talking specifically about the Sunbelt markets, Phoenix, Atlanta, Las Vegas. These regions saw an immense glut of inventory delivered in the 2022-2023 timeframe. Those markets are still working through that oversupply. This limits PSA's near-term pricing power and the application of aggressive ECRIs in those specific regions for, the next 12 to 24 months, forcing a geographically targeted revenue management strategy. #outro. So let's synthesize the verdict for the critical investor. Public storage is not simply a low-growth income vehicle. It is a definitive quality compounder that has utilized this challenging 2024-2025 cycle, a period of frozen demand and high capital cost, to structurally and permanently improve its margin profile.
The internal actions, that 75% digital transformation, the unprecedented negative 0.6% expense reduction, and the sustained 8.0% yield arbitrage on development are driving quantifiable outperformance relative to a peer set that is managing inflation and integration friction.
The investment case offers a really compelling risk-reward structure. You have this secure, growing 4.4% dividend providing a rock-solid floor, supported by that fortress balance sheet. But the bull case is clear. If housing turnover normalizes in 2026, those operational improvements will deliver a multiplier effect on FFO growth, potentially justifying a re-rating toward 20 times FFO.
The valuation gap exists because the market is focused entirely on the temporary demand headwind, completely missing the permanent efficiency gains that management has banked.
Which leaves us with a final provocative thought for you to consider. You are currently able to acquire shares at a price that implies terminal FFO growth of a mere 2% to 3%. Yet Public Storage has permanently engineered a fundamentally leaner, lower cost base, exemplified by that negative 0.6% decrease in same-store operating expenses in Q3 2025.
So what will be the multiplicative effect on future FFO growth when that cyclical headwind, that 9% decline in new customer move-in volumes, finally reverses and hits a cost base that is structurally lower than it has ever been? That latent high-octane earnings power unpriced by the market today is precisely the source of value you're acquiring.
Food for thought indeed.
That's all the time we have for this deep dive. Thank you for tuning in.